Hi, and thanks for joining us today. I'm in studio with Namir Hallak, U.S. tax principal here at Davidson & Company. Namir, structuring your U.S. business with an LLC, limited liability curse?
So we run into this situation a lot. A Canadian corporation or individual goes to their neighbor's friend's brother and asks them how to set up a business in the U.S. And they say, go structured with an LLC.
Google, how to structure my U.S. business.
Yes, except Google is not your friend for cross-border tax advice. LLCs are popular vehicles for setting up your business. They're easy to set up, they're cheap to maintain, and they're flexible enough to meet most of your needs as a U.S. individual or corporation. Not so much if you are a Canadian.
So why would that entity type work well for a U.S. company or individual and not a Canadian?
So by default, LLCs are taxed as flow-through entities for U.S. tax purposes. So every dollar earned by that LLC is treated as earned directly by the owner. By contrast, Canada treats the LLC as a taxable corporation, not a flow-through entity. So Canada considers the LLC itself to be earning income, but owners don't actually pay tax until the LLC makes a cash distribution to the owner.
Wow, sounds like a total mismatch from both sides of the border.
Yes, it's definitely a swipe left for cross-border tax if you want to avoid some ugly results. LLCs are hybrid entities because they get different tax treatment in the US versus Canada. The Canadian owning that LLC can end up paying as much as 70% in taxes on the income earned by that LLC, or up to 50% in capital gains as an individual owner.
So why are these hybrids costing Canadians so much more at the tax pump?
Well, income from the LLC is getting taxed twice, once in the US and once in Canada. And if that LLC is selling assets and pays those proceeds to its Canadian owner, that owner is getting taxed on the full sales price and not just the gain. Also, if the LLC is managed from Canada, it may also pay Canadian corporate taxes. Also, the Canadian taxpayer who owns the LLC, they may have to file a T1134, which carries significant penalties if it's not completed. 5, if the Canadian corporation has direct interest in that LLC, it'll also probably pay branch taxes on any income or gain earned on that LLC.
So what are some strategies our U.S. tax team could provide to Canadian taxpayers owning pass-through LLCs?
So one strategy, Bahar, is to harmonize the tax treatment on both sides of the border. You can have the LLC check the box and get taxed as a corporation in the US. Or the LLC can convert to an LP, a limited partnership, which is a flow-through entity in US and Canada. The Canadian taxpayer could also reorganize their ownership of the LLC. Another strategy is the LLC management can be conducted outside of Canada. Finally, tax plan your exit strategy. Canadian taxpayer can sell their LLC interest rather than have the LLC sell those assets and distribute the proceeds to the owner.
Wow, so it does sound like there's some solutions to fix that limited liability curse for Canadian taxpayers.
Absolutely. My advice, talk to our US tax team about your structuring solutions before you run into problems.
Perfect, will do, Namir. If you'd like to reach out to Namir with any U.S. tax-related questions, send us an email at ustax@davidson-co.com or give us a call at the number below. Thanks, everyone.